We begin with the SBUX chart, which could just stay range-bound in the near future, since selling pressure could be exhausted in the short term, allowing for the moderate 90 level to hold more easily, while the solid 9650 level can still present firm resistance in the next 2 to 6 weeks. So if the established downtrend regains momentum towards March, this kind of outcome driving down into the 80s can become more plausible. Next, the CGC chart, which will certainly focus on the 330 level, because even if a moderate upswing takes place around it, it's possible trading could still trend towards remaining within the central regions of the fan lines for further development of long-term bearish sentiment to push down beyond 330. And in the less likely case a major uptrend appears quickly, the price ranges marked in purple present the next major resistance barrier to rising price. So at this current time, there's still a bearish advantage to remain within the central portions of the fan for continued pressure on the 330 to 245 range. Now a look at the TSX index, which has been on a mostly neutral to bearish stance since the transition to 2024. Due to another short-term bullish spike, some are optimistic of this kind of breakthrough by the end of the month, in which case the main objective would be to enter the 21,700 to 22,100 range. Alternatively, a market that keeps a more neutral to bearish stance can look like this, leading to more pressure on the lower 20,000 support range, which can develop a potential reversal range further. Now to the stock market in Hong Kong, where a large downward channel has recently hit long-term lows, meaning contact near 14,600 could be quite reasonable if the general downward slope is maintained. Though if the market can keep over 15,100 moving into March, a more neutral to bullish stance could develop to reach further up into the channel. Breaking up and out of the channel in the near future looks less likely, because this region up here still presents major long-term resistance.